Breaking news this morning with the first reading of the first quarter GDP coming in at 2.3%, beating economists' expectations. Let's talk about the economy globally speaking and how to invest today. Joining me right now in a Fox Business exclusive is the chairman, CEO, and founder of the Blackstone Group, Stephen Schwarzman. Steve, it's great to see you.
Great to see you, Maria.
Thank you so much for joining us. So that number, we're looking at 3% expectations for the year. What's your take on where we are today in the U.S. when you look at growth? And then I want to ask you to look around the world because you've obviously been traveling a lot and have been investing globally.
I think the U.S. is in really good shape. You can see the earnings numbers that are coming in with a huge number of, I guess you would call them beats. We're seeing very strong activity in our portfolio companies, and there's a lot of business confidence at record levels, a lot of good things going on, and not a lot of bad things going on. So I anticipate we're going to have several years of a good run.
It's interesting to look at your most recent earnings because you had another incredible, strong showing for the model that you have, even with the backdrop of very fragile and volatile public markets.
Yes.
Tell us about that and what the portfolio is doing to be so resilient, even in the face of this uncertainty and volatility elsewhere.
Well, the way you have good results is you have companies that grow very rapidly compared to indexes. We have some real competitive advantages in our model of private equity, where when we buy a company, we have a plan before we buy it of how to make it, growing in a more robust way and earning more money, ultimately hiring more people, and we set that up before we do it, and so we're not trying to buy averages. We're not trying to perform in an average way. And then we put some leverage on it and make sure the maturities are out very far so we don't get into any financial difficulties. And that approach should get you somewhere between 750 and 1,000 basis points more than the stock market. And over time, it's done that. And so when you control things and fix them and accelerate growth and invest in those companies, they should do well, and they do.
Yeah, you've been anything but average in terms of your returns, obviously. In terms of the global story, you've been investing a lot over the years, but certainly recently you've talked a lot more about Europe because of valuations there in Asia. Take a walk around the world for us and tell us where you see opportunities right now.
Right. The easiest place to walk is Asia. China's growing 6.5% to 7%. India's growing a little faster than that. These are two very large countries. Australia hasn't had, I guess, a recession in 25 years. It's continuing to grow. So Asia has a very strong growth bias. Europe, which was quite slow 2 or 3 years ago, has come up and has had, I would say, acceptable levels of growth, lower than the U.S., but still, for Europe, quite strong. And we've had a chance to do a lot of investing in all of these areas, which has turned out uniformly to be very good.
I want to get back to China in a moment because I want to talk about your Schwarzman scholars, but also about what the U.S. is doing right now in terms of the China-U.S. trade relationship. But let me stay on the Blackstone model for a second. In terms of industry, in terms of the kinds of companies that are generating this type of growth, are they the same? Has it evolved? I know these are specific situations, Steve, but if you could talk a little about industry and where you're seeing the big growth numbers.
Well, we're spread pretty far around industry because we see life from the perspective of what we can buy and what we can improve. So we keep away from certain industries. Sometimes it's like a doctor, do no harm.
And which ones do you want to keep away from?
We keep away from retailing. We've had almost no exposure to that business, for example, which has been good. We've been quite heavy in terms of putting out money in the oil and gas business, starting right near the low prices, down around 26, 27 a barrel.
Wow, that's terrific.
Yeah, we've had all kinds of interesting things, and we're also just not in private equity. It's about a quarter of the firm. And we've quite a broad business, broader than anyone in the alternative asset area. Real estate is still continuing to be good around the world, particularly in Europe. It's been a real strong spot, as well as certain types of credit. And our hedge fund group has outperformed indexes in this down period. So overall, our style of investing leads to long-term pretty good success.
Well, the real estate business is a powerhouse business, obviously. Are you going to buy more in China? I mean, you had referred about what's going on in China in terms of real estate opportunities in the last earnings release. Are you looking to add to the real estate holdings specifically in China?
No, we're not targeted on that. Actually, real estate is pretty volatile in China because their stock market is quite immature. Their savings per family, if you will, are in the 30% plus range. So people have a lot of cash because the government, ironically, hasn't had the safety net that you'd have in a developed country. And so people save their own money. And there are very few places to put it. You can put it in a bank. You can put it in a, sort of a near bank, which has higher interest rates but higher risk, or you can put it in real estate. And as a result of that, the Chinese real estate market really is pretty cyclical. And today may not be the time to load the boat, but there are interesting things in terms of buying bad loans, if you will, which get created at certain points in the cycle.